Hi, this is Phil Chandler, and we are discussing cash-on-cash returns. Anyone who's involved in real estate investing needs to understand some basic financial ratios so that they can know when they're looking at an acceptable investment. Kind of makes sense, doesn't it? And one very important ratio is called cash-on-cash return. And actually, I consider it one of the more critical financial ratios when trying to determine what you can earn from an investment and whether one's better than another. Now, I realize it's at this point when lots of people's eyes start glazing over just because this involves crunching some numbers. But hang in there with me. This is a good one. So for this discussion, let's use an apartment investment as an example. But these ratios can be used on pretty much any investment you make with using your hard-earned money. So let's look at cash-on-cash return. A quick definition is that it's simply a ratio or a percentage of the total cash actually received back from an investment divided by the total cash that you took out of your pocket and you invested into the purchase. That's it. Or in other words, it's actual cash you received back divided by cash you invested. Now that sounds pretty straightforward, doesn't it? But of course, it's like anything else, there's always ways you can get it confused. The answer you give or that someone gives you can be confusing if you're not careful. So let's say you buy an apartment complex for $1 million. And we're going to assume you get a 75% loan to buy it, which is $750,000. And you put down the remaining 25%, which is $250,000 of your own hard-earned money. In addition, you also end up spending another $20,000 of your cash as part of due diligence and closing costs, which would be things like inspections, legal fees, escrow funding, title search, and lots more of those fun costs that show up at the closing table. So the total amount of cash you put into the deal is $270,000. You with me so far? All right. You keep the apartment for 3 years, and at the end of year 3, you sell the apartment. So let's look at the cash flow for those 3 years. And this is assumptions. This is a made-up deal. Let's say in year 1 you receive $23,000 in cash after depositing all the rents from the tenants and then pay out the operating expenses such as insurance, property management fees, property taxes, and then you also have to pay your bank loan, which we call debt service. In year 2, you receive a little bit more because you raised some of the rents. So you get $25,000 in cash. And in year 3, let's say you receive $27,000 because you raised the rents a little bit more. And then at the end of year 3, you sell the property. Hallelujah! And after paying off all the closing costs, real estate agency fees, and the remaining principal owed on the original loan, you get a check for $62,000. That's some pretty good lunch money right there. All right, so let's put all this together and see what we have. Many times when you see someone referring to cash-on-cash return, they're only talking about the first year. So in this example, let's look at year 1 cash. Return was $23,000, and you divide that by the total amount of cash you invested, which was $270,000, you'd get 8.5%. But over the 3-year period, you received what? A total of $23,000 plus $25,000 plus $27,000 plus $62,000 upon the sale of the apartments. So that's $137,000. So you take the $137,000, divide that by $270,000, and you get 51%, which sounds great, but I'm sorry, that's the wrong answer. Because you received all of that over a 3-year period. So now you need to get the answer back to an annual return. And you do this by dividing it by the 3 years because you always want to get it to an annual percentage rate. So when you divide by 3, you get 17%. That means over the 3-year period, you have received an average cash-on-cash return, or some people call it annualized cash-on-cash return of 17%. And that's pretty good. That gives you a good comparison of this investment against other investments. So, what I first suggest is when someone tells you that the cash-on-cash return for an investment is 10% or whatever, your first question needs to be based on what? Is that the first year cash on cash return, or is that an annualized or average cash on cash return? And for what period of time? And if it was an investment that occurred in the past and you're crunching numbers, and of course all of the numbers are historical and real, and it should be based on those actual numbers. But if this is for a proposed purchase that has not happened yet, then someone has to make some assumptions on the excess cash to be received each year, and how fast your rent's going to increase, and also what you sell the property for. So yes, it can be confusing, and most of the times you have to make a number of assumptions to get this ratio. What I tell everyone is that when someone gives you a cash on cash return percentage for a proposed project, your first response should be to ask questions on how they are creating this return. Do not assume that whatever someone tells you is the right answer. There are a number of ways to define and calculate this answer, so question everything. My name is Phil Chandler, and this has been another Real Estate Wrap-Up.